this video, I'm going to be showing you guys a mechanical based supply and demand strategy which you can simply follow and copy using a training plan which I'm also going to be providing you guys with. So if any of that sounds interesting to you, make sure to stick around until the end of this video. Make sure to like and subscribe for more content like this, and let's get straight into the video. Okay guys, so welcome back to the channel. So before I get into the actual strategy itself, I wanted to provide you guys with some proof that it does actually work and that I have thoroughly back tested this particular system. So you guys know that I only trade GBP USD and gold. I also used to trade euro pound as well. So those are the three pairs which I've back tested this system on over more than 3 years worth of data from 2021 to 2024 up to the current date. So before we start the video, I wanted to share with you some of those results. So if we go down to here, so it was these results. So this was for gold. Actually, sorry, this is for only last year. Okay, so it was these results. As you guys can see, it started in, I think this was August 2021 all the way up to this July of last year. And as you guys can see, these were the results which I was able to obtain. So basically the main statistics we want to focus in on are the average risk to reward, which in this case was 4.9, which means that if I was risking £1,000 on a trade, I would have made £4,900. And obviously you can scale that to whatever your risk is. And the win rate was around 81% over that 3 year period. So very decent. And you guys can also see down here that the frequency of the trades was very minimal. There are some months where I only take 1 or 2 trades. In actual fact, most of the months I only take 1 or 2 trades, which also explains the high win rate. You know, there's not really that many trades consistent happening during this 3 year period. I think at most there was probably 100 trades. And as you guys can see, moving into 2022, there was a few more per month, but still it's averaging probably around 5 to 6 trades every single month. 2023, same sort of thing, 5 or 6 trades per month. So, and as you guys can see, when we have a losing month, they're very minimal, so 1 or 2%. And then down here, you can look at all of these other statistics as well. But the point of me showing you this was basically to give you evidence that this system does actually work and can work very well if you are able to apply it without any human error, as is with the case during your back testing. There's no human error coming into play because you obviously don't have any emotional attachment to the trades that you're taking or the money that you could potentially be losing or making. So that was for gold. If we also look at the results for GBP USD, if we go and look at the results for gold now, we just did GBP USD. So for gold, the win rate was slightly lower, but still a good win rate nevertheless. And the average risk to reward was slightly higher at 5.19. So for GU, it was 4.9. Therefore, on average, we're making £300 more for every £1,000 we're risking. 67% win rate, which is obviously very decent with this sort of risk to reward. And as you guys can see from the graph, it is definitely a profitable system. And going down here, we have the same sort of thing where we're taking, 3 to 5 trades per month. Similar sort of thing in 2022. You can see that we have a few more losses on GBP USD, obviously explaining the lower win rate. And for 2023, similar sort of thing. Maximum I took in 1 month was 5 trades. And for euro pound, if we quickly go through that as well, the win rate again was slightly lower. I have now actually removed euro pound from my watch list because I found that it consolidated a lot, and every time I would get a clean setup, it would only have like a 3 or 4 pip stop loss. Otherwise the risk to reward wasn't worth it. And having a 3 or 4 pip stop loss is not very scalable. If you're trading that on, say, a £1 million account, you're not going to want to be risking, 20k over 3 pips, and you're probably going to get slipped the second you enter as well, losing an extra 2 or 3k or whatever it might be. And as you guys can see, the risk to reward was slightly lower at 4.5 with a 60% win rate, which is obviously still profitable. And as with gold and GU, you have this probably around the same amount of trades per month, so like 4 or 5. So if you are combining these two, so GBP/USD and gold, which is currently on my watch list, then on average you should end up taking around 5 to 10 trades per month, no more than that. So no more than 3 trades per week, I would be saying. So average is around 0.8 trades per day. So yeah, that basically gives you an insight as to the sort of frequency of the trades that we're going to be taking. And I know a lot of the frequency of the trades will align very nicely with a lot of your other sort of commitments, say work, school, whatever it may be. If you're only taking 5 to 10 trades per month and still securing that very decent return, which I just showed you guys, then that is obviously very optimal, as I know a lot of you guys are not full-time traders and therefore you cannot monitor the charts all day long. So taking 5 to 10 trades per month will obviously not take much out of your time. So if we actually get straight into the trading plan itself now. So I've divided this plan into basically 3 sections. The first one is strategy, where we're going to go through the rule set behind actually entering and executing trades. We have a subsection for targets, so where we're going to be targeting, and one of the most important subsections, money management as well, which is going to be how much we're risking per trade and what is our minimum risk to reward, things like that. So first of all, if we begin with the strategy itself and how I'm going to be explaining this, I think it's best to go through an example step by step as we look through the trading plan. And I'm going to do one example for each type of point of interest that I'm going to go through. So if we get up an example for the first point of interest, first of all, and a very good example was on gold back in January. So step 1, as with any trading plan which I've ever discussed with you guys on YouTube, we identify the macro trend structure on the daily and the 4-hour. So basically just identifying what is the current market direction, where is price heading, and yeah, basically just identify the macro trend structure. So if we go ahead and do that, starting off on the daily and using the 4-hour as well, like I mentioned. So overall, at this point in time, price was clearly bullish on the daily. We had a mitigation of this area of demand. Price had then broken daily structure just here. B just stands for break of structure. It's just a way of shortening it, so I don't have to draw break of structure on the chart every time I mark it. Price has then retraced into a discount of this current trend leg into this area of demand just here. And if anyone's unfamiliar, the discount of the leg just means if you draw the fib tool from the low to the high, it is below the 50%, as is the case here. So on the daily, price is clearly bearish. We've had demand hold multiple times and price is still creating higher highs and higher lows. On the 4-hour, we can refine this demand just to this level here. And on the 4-hour, what we want to do is basically to identify any sub trends. So obviously you have this main trend on the daily time frame where we've had this daily break of structure followed by a daily retracement. However, on the 4-hour, we can also look at this trend, which is obviously an internal trend because it is not the main macro trend. And in this case, what we can see is that the 4-hour is actually still bearish. This was the most recent 4-hour break of structure just here. So this is the current trend high, this is the current trend low. So for price to remain bearish on the 4 hour, we don't want to see it break above this high. Therefore, and if we are going to be looking at some sell positions, we want to be aligning ourselves with this trend and only looking between this high and this low to give us sort of a clearer picture of where exactly we are going to be looking for the sell positions. On top of this, we have all of this imbalance below, and we have this unmitigated demand at the bottom of that imbalance. So before price continues up on the daily time frame and takes out the daily high, if it is going to do that, we would expect price to come slightly lower and fill in some of this inefficiency and head towards that 1985 area of demand. So that brings us to step 2, identify internal trends and order flow on the 1 hour. So we've identified this 4 hour trend, and we've ascertained as to the direction in which we're going to be taking trades. So in this instance, we're only going to be looking for sell positions because the 4 hour is bearish, and we have this area below where we know that price is likely to gravitate towards. So that gives us our directional bias. And as mentioned, we're going to be looking for some sell positions between this high and this low because that's the current trend leg. So identify internal trends on the 1 hour. What this basically means is that so we've got this 4 hour sell leg, but if we look at that 1 hour at the moment, price is creating higher highs and higher lows. If we're just looking at this trend right here, which obviously we know because of the 4 hour bearish trend, this is likely just to be a retracement. But what we can identify is that just looking at this, price is bullish on the 1 hour, which brings us to step 3, which is within this current price leg, identify a point of interest to buy or sell from. And for this example, we're going to be going through the first point of interest, which is simply looking at an imbalanced area of supply. And as for the criteria of what I qualify as a valid area of supply, it has to be imbalanced, it has to have some higher time frame liquidity below it, and it has to be in a premium of the current trend leg, which means that it's above the 50% fib. So if we draw the fib between the high and the low, you guys can see that this anywhere above this 50% is our premium levels. And what we can identify is that, so we're looking for imbalanced areas of supply with some liquidity below them. And what we can see is that I would basically consider 2 valid areas. The first one would be this area of supply. So drawing the supply between the bottom wick of this buy candle and the top wick of the same buy candle, because this is where the volume came into the market. So that is our area of supply. The other valid one that we have is also this one up here, which again created imbalance. We have liquidity below it and it is above that 50%, so it is in a premium. So also, I forgot to mention, below this area of supply, we obviously have this liquidity as well, where people were previously selling within this range. So all we're doing now is going to step 4, and we are going to be looking for some entries, as obviously we don't just want to set a limit on this area, as that is quite low probability in my opinion. So in order to give us further confidence in this trade, we are going to be using a lower time frame entry model. So where I see a lot of people get confused with supply and demand is they don't know what time frame to look for a confirmation on. So let's say price is in their 4 hour point of interest. They then will go down to something like the 1 minute and look for an entry. But what they don't realize is that there is such a big discrepancy between the 4 hour and the 1 minute that the 1 minute structure relative to the 4 hour is pretty much meaningless. So you want to be basically correlating the right time frames. So that's why I've made it easy for you guys. And what I've basically done is, depending on which point of interest, depending on what time frame the point of interest is based, we are going to be using a specific lower time frame. So as we can see here, if the point of interest is on the 4 hour, we use the 15-minute for confirmation. If the point of interest is on the 1 hour, you can also go to the 5-minute, but you can also use the higher time frames as well. So basically, if the point of interest is a 4 hour, we don't go lower than the 15-minute. And if the point of interest is on the 1 hour, we do not go lower than the 5-minute. So we're not using the 3-minute or the 1 minute, basically. And as for the entry confirmation itself, it's very simple. We look for a breaker structure. So to explain this a little bit more, at the moment, price is obviously bullish on the 15-minute, which is our entry time frame for this point of interest. So what we want to see is price is clearly bullish, moving towards this area on the 15-minute. What we simply want to see for the confirmation is for price to break structure in the opposite direction to this uptrend. So that means it has to break below and close below the most recent higher low. And going back to this, it also has to create imbalance. So something like this is ideal, and that's what we want to be looking out for. So if we just play price, and it will be easier to explain once that actually happens. So first, if we get rid of this zone, and as I said, we're going to be looking on the 15-minute for this particular setup. And on the 15-minute, we can already see that price has started to break down and break some of these levels of structure. In this case, the sort of main area of structure that I would have been considering would have been this one, as this is the most recent higher low, which put in a new high. All of this in between, I wouldn't really consider that a pullback. It's just sort of consolidation. And crucially, we got a closure below that level with the candle bodies. C just stands for CHOC, which is change of character. And as for the next step, we simply identify an area of imbalanced supply to enter from. And in this case, what we can see is that we have this imbalance up here. We have this wick as well, which is a form of liquidity or inducement. And we have this imbalance level of 15-minute supply just there, which we'll mark in blue. And all we do now is set a limit at this zone. Stops just above the wick. I wouldn't have it this tight. I know a lot of people do that. A lot of the times what you'll see, particularly with gold, is price will wick above these areas of supply, manipulate them, and then price will drop in your favor. So what we want to do is have a more conservative stop loss above the wick high. And if we go down to targets, I've made this as mechanical as possible for you guys. As I showed you via the backtesting results, the win rate for gold was around 80%. So obviously, if the win rate is 80%, then you're going to be profitable with a 1 to 3 or even a 1 to 2, in fact. So, yeah, so we would set the limit at this point and target a mechanical 1 to 3. And then we would just be waiting for price to tag us in. And this limit would be valid until basically price creates a new low on the higher time frame. So in this case, the limit is still valid even though price has created a new break of structure. So a lot of people will be seeing this as a break of structure. They'll be entering somewhere within this range, but for us, this basically is just an inducement below the area of supply. On top of that, we also have these sort of equal highs that are formed as well, just here, which again is another form of liquidity, giving us further confidence in this trade. So again, we're just waiting for price to tag us in now. And there we go. So price tags us in. And eventually price also hit the take profit on this one, because this is one that I actually entered back in January. So there we go. Price messed around for a little bit, but ultimately hit the take profit. Another thing I want to mention as well, you can see that price came back and tapped our entry multiple times. So for this strategy, we are not making break even unless there's some form of high impact news such as NFP, FOMC, or CPI. Those are the main ones. I wouldn't really worry too much about the others. I would just go ahead and I personally just enter even if those news events are coming out, if they're not one of these three main ones. PPI would also be one, actually. So anything to do with interest rates or inflation, I would stay away from. So yeah, that's, as discussed, point of interest type 1. And if we move now on to point of interest type 2, and there was a very clean example of this on Euro USD back in, where was it? Back at this point just here, in February. So again, what we are doing, first step, identify structure on the daily and the 4 hour. On this, in this particular instance, I was only using the 4 hour as the structure was most clear on the 4 hour. So what we can identify is that currently the main break of structure on the 4 hour and the main trend leg is this one just here. So we've had this 4 hour break of structure. This is the swing high and this is the swing low. I wouldn't consider this as a break of structure since price did not close below this wick, and therefore this just becomes liquidity or a weak high, whatever you want to call it. So what we want to be doing then is waiting for price to retrace into a point of interest. And for this point of interest, this is going to be type 2. And type 2 is basically a higher time frame liquidity sweep. So to make this as mechanical as possible, once again, I have 3 criteria that we need to see for this to be valid. The first, looking for sellers to be swept in a downtrend for sells, and only looking for buyers to be swept in an uptrend for buys. So since we are in a downtrend, in this instance, we are only looking for some sellers to be swept. So all of these previous sellers within this range, we want to see them swept for then continuations to the downside. And another criteria that we have is that price taps into an imbalance after sweeping the liquidity. So for example, what we can see here is that we have this 4 hour wick, which is internal liquidity, which then leads into this imbalance just above. We also have this one just here. Sorry, this is liquidity. There we go. And both of these liquidity points have imbalance above. Therefore, is with high probability, you'll get a reaction once price sweeps these 2 areas. So for this particular trade, we were looking at a sweep of this area. Going on the 1 hour as well, you can see that it was sort of this lower high that was previously present in the market. And on the 4 hour, it was, like I mentioned, that last bit of liquidity before the imbalance. You could also say it aligns very nicely with a break and retest of this area, which was the previous lower low that price broke out of. So if you trade support and resistance, that's a nice extra confluence for you as well. And as for the entry model, this is the same as before. So we're looking for a break of structure in the opposite direction to this current uptrend. And then we're looking for an imbalanced area of supply. So in this case, since this was a 4 hour point of interest, we want to be making sure that the confirmation is seen on the 15-minute. So in the live market, what I would have been doing at this point in time, since price has now swept that 4 hour liquidity to the left, if we also mark it with a blue line, so we can see that price has just swept that blue line. What I would do at the time would be to mark on the structure that I want to see broken for this to be a confirmed trade. And in this case, it's this higher low just here, as this is the higher low, which put in a new high, breaking this structure. And obviously, if price starts to do something like this, where it pulls back, breaks structure, then this new low would become the one you want to see broken, something like this. But for now, we want to see this area broken and that would give us our change of character. Okay, so now since price has pulled back, broke structure again, breaking past this high, this higher low is the one that we want to see broken for the trade to be confirmed. And as we can see, what did price do? You can see that, so this would be viewed by many people as a break of structure, but price then instantly closes back below, melts below it with all of this momentum. It created imbalance, and we also have a very nice area of supply to enter from. So once again, drawing it from the wick low to the wick high, this is the candle which caused all of this momentum and broke this area of structure as well. And therefore, this is now valid for us to set a limit on this area. Stops just above the high, and as always, mechanical 1 to 3. So around this point. Obviously as well, you could also make a rule if you don't want to do a 1 to 3 and you like a more discretionary approach, you could target, say, the most recent low, which is down here, giving you a much bigger risk to reward of 5.5. And that is what I did when I was backtesting this, by the way. As you guys saw with the average, I think it was 4.9 R to R on gold and something like 5.2 on GBP/USD. So if we see if this tags us in now, also notice that an extra compliments we had is price created this liquidity below the zone before coming back into it, which is something I normally wait for. Just for an extra confluence is to see if price can create some inducement liquidity below this zone. And like I said, at this point in time, we would have just been waiting for price to come into the zone. And of course, this would become invalidated if price breaks this low just here. Further confluence now as well, price has created these two equal lows. So until these are swept, it is very unlikely price will break higher since it hasn't taken all of the liquidity yet. And as we can see, this was when I think it was CPI news came out. That is exactly where price taps back into and then just melts over to the downside, taking out these two equal lows. So that is basically the entire strategy. As I said, I wanted to make it as mechanical as possible for you guys, and I've done exactly that with the specific criteria that we have for each of the trades. Money management, last topic that we want to discuss, and arguably one of the most important, is how much are we going to be risking per trade. So for those backtested results that you guys saw, I was doing 1% risk per trade. Obviously, this is going to depend on how risk averse you are, your personal risk tolerance. I would say though, if you guys have a live funded account, I would do 0.5% risk, 1% risk on challenges. And on a personal account, I would also do 1% risk, as that's what I personally do. And I would also keep it to 1 loss maximum per day. As I showed you guys before, the trade frequency is very low, meaning that I was only taking around 5 trades per month on each pair. Therefore, you know that if you are taking more than 1 loss per day, then the second or third loss, basically any loss you have past the first one, was likely an emotional decision based on revenge trading, anger, greed, fear, whatever it may be. And having 1 loss maximum per day basically just circumvents this problem. You don't obviously have the problem of revenge trading because you can't enter the next trade. So yeah, 1 loss maximum per day, max 1% risk, but 0.5% risk if you are on a live funded account, and only make it break even when we have some high impact news such as one of these 3, or anything to do with interest rates and inflation data. Those are the main ones which move the market. The other ones, like your PMIs and building permits, I wouldn't worry too much about those. I would just, if you do have a limit set or you are looking for a trade, I would continue to do that and not avoid those news events. Obviously be mindful of slippage as well. So yeah, that basically concludes this video. If you guys did end up enjoying, make sure to like and subscribe. And as always, I will catch you next Friday in next week's video.